Why are prospective returns low? Again, at Chicago, it all starts here at Chicago for me back in '67. And I learned about the capital market line. And it begins over at the left with the risk-free rate with zero risk. And it proceeds up and to the right to offer investors a potential risk premium as an incentive for bearing incremental risk. That's how the market works. Now, I'm going to take a minute out, since I think I have plenty of time today, to say, you ask most people, what does this slide mean? Think about it for a minute. Ask yourself, what does this slide mean? Okay, time's up. What most people would say, in my opinion, is two things. Number one, riskier assets have higher returns. And number two, if you want to make more money, the way to do it is to take more risk. Everybody agree? I don't get any agreement? Okay. And I think that both of those are terrible formulations for the simple reason that if riskier assets could be counted on for higher returns, by definition, they wouldn't be riskier. So that's a fallacy. And if you are guilty of that fallacy, or have been consciously or unconsciously guilty of that fallacy, I think you should check your reasoning. Riskier assets cannot be counted on for higher returns. In my opinion, what this relationship means is different. What it means is that assets that appear riskier have to appear to offer higher returns. They don't have to deliver. So the important thing is to keep that distinction in mind. But anyway, most of the time, the market does look like this. Longer bonds have higher yields than shorter bonds. Low quality bonds have higher yields than safe bonds. Stocks have higher expected returns than high quality bonds, and alternative investments offer higher returns than equities. They merely don't have to deliver. So we get a dialogue. And it goes like this. And let's go back 20 years to 1999. I wrote a memo about this back in '04. I'm still quoting from it. I've gotten a lot of mileage from it. It's called Risk and Return Today. And what I observed in '04 is back in force today, I believe. So people would say, well, I can get 4% with no risk in T-bills. If I'm going to buy the 5-year Treasury and tie up my money for 5 years, I need 5%. If I'm going to buy the 10-year, I need 6%. If I can get 6% with no risk in a 10-year Treasury, I need 100 basis points more to buy corporates with credit risk, so that's 7. If I can get 6 in 10-year Treasuries, I'm not going to go into high yield unless I can get 11. And that's the fixed income world. And if I can get those kind of returns on fixed income, I'm not going to buy quality stocks unless I think they'll return 9. NASDAQ, I need 10. And by the way, if I can get those returns from public securities, I'm not going to develop real estate unless I think I can make 14, or go into private equity unless I think I can make 20, or venture capital unless I think I can make 30. So all along the line, you get people saying, in order to take incremental risk, I need the expectation of incremental return. Nothing could make more sense. And that is the way the world was back in 1999. Then we had this thing called the global financial crisis, and the central banks pulled down the risk-free rate from 4 in 99 to about 0. In some countries, of course, short-term rates went negative in order to stimulate economies, recapitalize financial institutions. And when the risk-free rate was pulled down to 0, everything else followed. And now it goes like, well, if the return on cash is 0, I'm not going to tie my money up for 5 years unless I can get 1. 10 years, I got to have 1.5, and so forth. I wouldn't buy high grades unless they paid 3. I wouldn't buy high yield unless it paid 6, and so forth. So you can see that the demanded returns, all investing is relative. The decisions are relative decisions, and so all of the decisions are still sane in relative terms, but taking place at lower levels in terms of prospective returns. So this is the reason why prospective returns are low today. And this is, of course, as I say, I think the most important single characteristic of the financial environment over the last decade. Now, investors in many markets have taken on increased risk in order to access returns above those on safe assets. So the person who used to, like me, all the money I had in 06-07, I was concerned about the environment, so I took all the money that I had outside of Oaktree and I put it into treasuries. 1, 2, 3, 4, 5, 6-year treasuries. It's called a laddered portfolio for those of you who are in the bond business, and it is the dumbest form of investing known to man. You have this progression of yield of maturities. The closest in one matures, it goes to the back of the line. You always have a portfolio which has 1, 2, 3, 4, 5, 6-year maturities. You always have some money coming due within a few months, and you can't make much, but you can't lose. And the yield on that portfolio was over 6 back in 07. And of course, today it would be over 2. So most people, I meet with pension funds and endowments and insurance companies, and they can't invest for 2, 3, 4%. Many of them need 7 or 8. So that means you can't do much in the low return, safe assets that you used to invest in. So people have had to push out the capital market line in pursuit of tolerable returns in the low return world. That has caused there to be a lot of money chasing limited opportunities in the risk markets, the safe close-in markets, the government bond market, high-grade bond market, even the stock market, are by definition much larger than the alternative markets of real estate, private equity, venture capital, and so forth, and even private credit. And so you've had a lot of money moving from the safe asset classes to the risk asset classes, and when a lot of money hits a small asset class, we know what happens. And I believe that as a result of the demand for returns, well, let me say this. In February 07, I wrote a memo called The Race to the Bottom. And I said in there that the market for buying investments or making loans is like an auction house. And when an opportunity goes up at an auction house, it goes to the person, the highest bidder. The highest bidder is, by definition, the person who is willing to accept the least for his money. And the same is true of the securities markets. I want to buy some stock. I want to pay 32. Josh says he'll buy it at 32 and a quarter, and Tom says he'll pay 32 and a half. I don't get any. Tom gets the stock. He's the highest bidder. But of course, he gets a worse deal than I would have got at 32, but he makes the investment. The trouble is that when there's a lot of money in investors' hands and they're hot to trot to put it to work, then the bidding maybe goes too far. And in the credit markets, people bid up the price, which means they bid down the yield and they bid down the safety. That's the way the auction goes. And I believe that the race to the bottom has been underway in the credit markets. And that is to say, investors are competing for the limited opportunities in the risk markets by volunteering for low returns, weak structures, and high risk. Again, next question, do you agree or do you not agree? That's, as we go along, that's a question that you should all be asking. So I believe that we have seen over the last few years what I call the 7 worst words in the world: too much money chasing too few deals. And that was the title of my September memo, the 7 worst words in the world. When that's going on, is that going on? Do you think it's been going on? When it's going on, that's troublesome, and you should recognize it and act accordingly. How are high returns achieved? High risk-adjusted returns. How do you get high returns with low risk? The answer, in my experience, is investors make money most safely and most easily when they do things that other people are unwilling to do. That's the history of my career. I started Citibank's high-yield bond portfolios in 1978 when nobody else would do it. and it was considered unfiduciary and imprudent to buy an investment-grade bond. We started the distressed debt fund at TCW in 1988 when people said, are you crazy? You're going to buy the debt of bankrupt companies? How can that end? Nobody else would do it. That's how you get bargains. When investors are unworried and glad to make risky investments, or worried but investing anyway because the low-risk alternatives are unappealing, which is more descriptive of the last 10 years, asset prices will be high, risk premiums will be low, and markets will be risky. That's the result of too much money and investors who are too eager. What will help us avoid the extremes of the markets? And the keys to avoiding mistakes are simple. Awareness of history, belief in cycles rather than unabated unidirectional trends, skepticism regarding the existence of free lunches. You know, there just aren't that many opportunities to make a lot of money without risk, regardless of how often they are pandered. Insistence on low purchase prices that provide lots of room for error. And attention to all these things invariably will cause you to miss the most feverish parts of bull markets. You can't have everything, which is when prices go from fair to extreme, but they will also make you a long-term survivor. And I think that's very important. You can't have it both ways. You can't guarantee participation in the appreciation in a heated bull market and be prepared for its reversal. So I wrote my first really cautionary memo of this cycle in July of 17, and I got the rare treat of turning on the TV and watching it being debated. And these are some of the things people said on TV. One guy said the story from Howard Marks is it's time to get out. And I said to him, there's only two things I would never say. Number one is get out, and number two is it's time. Because you know, our industry, our field of endeavor does not permit that level of certainty. I would never say those things. And then you can read for yourself the other things that people said about the memo on TV. But I'll read you the last one. And one guy said, I appreciate Howard Marks's message, but I think now is no more a time to be cautious than any other time. Skip a little. It says, this means that durable portfolios, hedges, cash reserves, etc., there is no better or worse time for any of these things that we can foresee in advance. That's what he said. And I take issue with all the statements up there now, but most importantly, with the last one. We're all, I assume everybody here is in the investment business. What do we do? What do you do? What is your job? Oh, it's to manage money. No. What is the job of the money manager? And the answer, I think, is that everything we do falls into one of two categories: asset selection and cycle positioning. Asset selection is trying to hold more of the things that will do better and less of the things that will do worse. And cycle positioning means trying to have more money invested more aggressively when the time is right, and less money invested more defensively when the timing is wrong. Positioning for the cycle. Those are the two things we do. I don't think there's anything we do that doesn't fall under one of those two headings. And accepting that there is no better or worse time for defense versus offense means giving up on the latter, tying one hand behind our back. And I think it's a mistake. I think we can, especially at the extremes, increment our performance by being aggressive at the right time and defensive at the right time. There are times for aggressiveness and there are times for caution. When prices are low, pessimism is widespread, and investors flee from risk, that's the time to be aggressive. When prices are high and enthusiasm is rampant and investors are risk tolerant, that's the time for caution. Which is this? That's the question. Very simple question. Not always easy to answer, but a very simple question. Do you agree that sometimes it's better to be on offense or sometimes on defense? Do you agree that these are the things that determine those times, which is this. Very simple. So, the decision today, these are the questions to ask to try to figure out which this is. Are investments rich or cheap? Where do we stand in the market cycle? That's what the book is all about. How should we be positioned versus our normal risk posture? Every one of you and every client and every institution should have a normal risk posture based on your financial condition, your aspirations, your ability to stand pain, your emotional constitution, your needs, etc. That's your normal position. Where should we be today vis-a-vis our normal position? Should we be emphasizing offense or defense today? Should we worry more about losing money today or worry about missing opportunity? Now, this is very important. Every one of us in this room faces two risks every day. The obvious risk that everybody knows about and nobody likes is the risk of losing money. The more subtle risk, which not everybody thinks about, is the risk of missing opportunity. Now, you could say, Howard, I want to be sure that I don't ever lose a penny. I don't want to ever have a down day in my portfolio. I couldn't take it. I say, okay, we'll put you all in 30-day bills. You'll never have a down day and you'll miss all the opportunities. But if you say, look, I'm a young guy, I have a big risk tolerance, I know what I'm talking about here, I want to make sure I don't miss any opportunities. Then we say, okay, no treasuries for you. And now you are 100% exposed to the risk of losing money. So the point is you can eliminate either risk, which puts you entirely at the mercy of the other risk, or you can balance them. And what do most people say? Well, I don't want to lose a lot of money, but on the other hand, I don't want to miss all the opportunities. So I'm going to operate in the middle. I'm going to have some risk of losing money and some risk of missing opportunity. And most of us maintain a balance somewhere in the middle, hopefully as is appropriate for our circumstances and our client circumstances. And then the next question is, vis-a-vis your normal balance of the two risks, what should your balance be today? Do you believe in trying to change the balance as the environment changes? Or are you just a buy and hold investor? And it's not necessarily wrong, because changing it is not easy to do. Or do you want to give it a try? And lastly, if you go back 10 years ago, it's a great time to be here, because February 22nd of 2009, if you wanted to make a lot of money, you only needed two things: money to invest and the nerve to invest it. That's all you needed. You didn't need a lot of brains. You didn't need selectivity, caution, conservatism, discipline, patience, agility. All you needed was money and nerve. And if you had those things over the last 10 years, you've made a ton of money. Does that mean that money and nerve is the formula for success in the investment business? No, because if you had money and nerve in April of 2007, you lost a lot of money. You bore the full brunt or more of the global financial crisis, and maybe you got knocked out of business. That's when you needed caution, conservatism, risk control, patience, selectivity, and discipline. So the point is, there are different tools for different climates, which is this: money and nerve today, caution and conservatism today. And Oaktree's mantra over the last several years has been move forward, but with caution. I don't think that asset prices are so high. I don't think the outlook is so bad that you should practice maximum defense. And the return for being in ultra-safe assets is unacceptably low, so for most of us. But on the other hand, I don't think that prices are low enough or the outlook is good enough to be practicing sheer aggression. I don't think there's any place for aggressiveness in today's market. So that's where we came up with this balance of move ahead, but with caution. We're investing every day. We're basically fully invested and trying to stay that way, but with a portfolio that is biased toward defense, not offense. Biased vis-a-vis our norm. So, how should you invest in a low return world? And I've come up with 6 possibilities. I put them up here. and I'm not aware that there are any others. Number one, invest as you always have and expect your historic returns. Well, that's actually a fake, because nothing, in my opinion, offers the return that it historically has offered. So that's a red herring. I just want to make sure I had your attention. The second one, invest as you always have and settle for today's low returns. That's more like it. That's more realistic. That's more prudent. It's just not much fun. And for many organizations, it doesn't fit the business plan. The third is to reduce your risk to prepare for a market correction and accept still lower returns, and that's even less fun. The fourth is to go all the way towards defense, go to cash, accept a return closer to zero, and wait for a better environment to put that cash to work. That's very challenging, because going to cash is an extreme action for an active investor. And not only do you have to be right, but you have to be right quick. Because if it takes you 2 years to be right, you'll have dug a hole that if the market keeps going up in those 2 years and you were wrong to go to cash, you'll have dug a hole so deep you may never get out of it. And by the way, you may not have a shovel anymore, because you may have lost your job. So that's number 4. Then there's number 5, which is to do the opposite, to take on more risk in the low return world in order to try to get the returns that you used to get with safety. That has obvious merits and demerits. And number 6 is to put more into what you would call special niches and special people. That is, bet more on alternatives, non-market, private, and hopefully skilled managers. Now, the important thing is that none of these alternatives is completely satisfactory. Every one has a downside, including number 6, because you go into special asset classes with what you believe are special managers, and you expose yourself to manager risk. The risk that you thought you were finding somebody with alpha, but he or she actually turns out to have negative alpha and underperforms. So, as I say, none is completely satisfactory, but I think there are no others. So now let's talk about pursuing superior returns through number 6. According to the efficient market hypothesis, which I was taught here at Chicago, there are no mispricings to find and no such thing as the skill to find them. That is to say, you can't beat the market. You can't have alpha. You can't contribute through active management. And that means that an investor's return will be nothing but the product of the market's performance and the portfolio's degree of sensitivity to that market performance, systematic risk, or what we call beta. Market times beta. Performance is alpha, manager skill, plus beta times the market's return. Efficient market hypothesis is there is no such thing as manager skill, so it's all beta times the market. And if that's true, then the only way to try for a higher return in an efficient beta market is to take on more risk. And for the reasons described earlier, today's beta markets generally offer unusually low prospective returns. You have to decide for yourself whether you accept these as the premises. There are really only 3 ways to strive for high returns in a low return world. Increase your risk, as just described. Rely on getting lucky, or locate inefficient markets where it's possible to profit from alpha or personal skill, and of course, locate managers who have that alpha. The mere fact that a market is an inefficient market, and by the way, I believe that A, there are no markets which are perfectly efficient, and B, there are markets which offer inefficiency. That's the ones we try to work in. But people say, oh, I'm going into XYZ because it's an inefficient market. Merely going into an inefficient market does not mean they hand out money. It doesn't mean that everybody goes into that market and makes an above average return or an above average risk return, risk adjusted return. What it means is that unlike the efficient markets, where there's no such thing as skill or unskill, and as a consequence, everybody performs about the same in the long run, in the inefficient markets, there prices deviate from fair value. So there is scope for a superior manager to do above average through the application of alpha, or an inferior manager to perform below average due to the presence of what you might call negative alpha.